Welcome back, Maverick traders, to your currency midweek update, January 11th, 2023. Fun start to the year so far. Markets are behaving as I kind of anticipated, which is we're still seeing that ABC correction higher, a little bit more of a transition to risk on, away from risk off, and I think there's a little bit more room for that to go, but let's make sense of this together and kind of go through some things. So some of the themes that are in play right now, that ABC correction in the markets, this doesn't mean we're out of the bear market either. It's kind of, if you follow Elliott wave, if you go look at a chart of the S&P, we had three big waves to the downside, which is your 5-wave move, right? 1, 2, 3, 4, 5. And now we're in the correction phase, which is basically we had a shot up, we established a higher low, and then we're currently right here kind of making this next wave. That's your ABC. Now that doesn't take you out of the bear market. It's just a big correction that confuses, confounds, really shocks a lot of people at how strong it is. But ultimately, I don't think that it's up and away. I still think equities go lower. This will be one of those years where there's not a lot of years where you go back-to-back negative. The S&P 500 doesn't have a lot of those where it's like it was down last year, it's down again the next year. Usually you bounce back, but there are exceptions to that. And I've been trading for over 20 years, and if I think back to the bubbles that I've lived through, what are the three major bubbles that I can kind of think of? Tech stocks, the tech bubble in the 2000s, right? The real estate bubble, and I'm going to call it all things financial markets because it was the financial stocks that were funding that, giving out interest-only loans and all sorts of stupidity that was happening there in '07. And then really, I'm going to say crypto and NFTs and all of that nonsense where, non-fungible tokens and all these different things where that was stupidity as well. And we're going to call that kind of bursting in 2021, fueled by 2020, by the way. So it had already kind of been leading up to that. And most of these bubbles are some form of credit. It's capital, it's easy money. We had an economic boom and technology. I mean, I tell stories to my kids. Look, I didn't grow up with cell phones and all these sorts of things. I can remember when the internet was essentially created and going to the internet and being like, wow, this is amazing, as you'd sit there and wait 10 minutes for it to go, and you'd see the web page loading minute by minute, and you'd start to see some of the words and so on, and then it would just keep creeping down, and you'd sit there and wait 10 minutes so you could read a page of something, and so it was an entirely different world. Tech really, yeah, that's probably not the right noise, but if you go back and look and listen to those modems, I'm not sure why it had to make that noise either, that noise that it made. But anyway, the technology bubble where everybody piled in to day trading tech stocks. Everybody tried their hand at it because it's all fueled by envy. Envy is a very, very powerful emotion. And in the late 90s, essentially, as everyone was becoming a millionaire on tech stocks on paper, it drove envy. And when you're envious of others, you'll go do some stupid things, right? And so envy drove that one, and envy drove the real estate bubble, because in this case, if I can spell and talk at the same time, envy drove the real estate bubble because everybody that I talked to back in that period seemingly wanted to buy into investments and buy their second or third home or get into real estate and work selling homes. And it's just this boom. And as you see other people make money, you too want to participate. And guess what people have been talking about at Thanksgiving time for the last couple of years? All of these new millionaires in the crypto space. And nobody wants to see people make money without them. And in each of these cases, it was fueled by the Fed, by easy policies, by too much money in the system. That's what drives these things, right? And so 2020 and COVID, when they started sending out checks and all of these money printing measures, and they did these things for corporations where they would give PPP loans and all these sorts of things. Look, it fueled a boom because that capital had to find a home for it, and it burst, and it burst on us in 2022. And of course, crypto and NFTs and those things have collapsed. But go back and look at these bubbles bursting, and it's not just a quick, easy fix. It's not something that's just here today, gone tomorrow. And 2020, the technology bust, the NASDAQ ended up dropping 85% in value. It lost the vast majority of its value. Didn't go to zero, right? But most of the companies, or a large amount of them, went to zero. Look at the financial crisis of '07. We had an over 50% drop in the entire market. And again, the financial sector lost, 80% of its value. And then you go to crypto, well, that was kind of at the center of it, but there's other things that are going to go down. Those other things might go down, 40%, but crypto is going to lose 85, 90, and in many cases, in most cases, probably 100% of its value, because a lot of those cryptos are like the tech stocks of the 2000 bubble. A tech stock that was nothing more than a website. They didn't have any revenues or anything like that, and they eventually went to zero. And by the way, a lot of these coins and NFTs and things are on their way to zero. The vast majority of those crypto assets are going to do that. So I don't think we're out of the woods by any means. And so I've been calling for a rally. A rally is happening, but I would rather, do you keep playing the market to the upside carefully, cautiously? It's a small reward, probably has more to go, but it's a smaller reward. The bigger reward is when things turn back down. That's when I think we're going to see some ugliness this year. So I would be of the mindset that, look, for now, I think people got too pessimistic. I think they had it all backwards. They kind of thought that we were going to have a rough start to the year and so on. And I've talked about this the past few weeks, that is not my opinion. I've been expecting a risk-on move first, and then we get the deterioration that comes after. And so this shift from quantitative easing, from easy policy to quantitative tightening, it's real, it's in effect, and it's happening. And like we said, last year was the first year in, unless you were born, there's probably somebody on here that's 70 years old or something. In their lifetime, they might have seen a year where the money supply went down. But for any of us that are about 50 or younger, I'm approaching 50, we have not seen that. We have not lived in an environment where we have had the amount of money supply go down year over year until now. 2022 was the first year in my lifetime. So economic reports, Australia CPI came in at 7.3 versus the 7.2 expected. The US has a CPI number coming out this week, and that is expected to bring fireworks. So we'll touch on that more. We're in risk-on mode, right? In S&P and international stocks and crypto and gold and oil. Oil's up 4.5%. We do a year-in review video for both the FX side and the equity side. And the Japanese yen had a rough year last year, but it surged at the end of the year. It was going to have a terrible, terrible year. But we talked about this reversal. I don't know what their outlook is going to be on the FX side, but if it were me, I would be very optimistic on the yen for 2023. So if I'm making a full year forecast for 2023, I'd have the yen up there near the top of the board. I also have talked about this. I think oil's one of the better commodities. I think the energy patch, that's a little bit different than some of our other traders feel like. We had a little bit of a board bet, if you will, where Darren and Rob are a little more pessimistic on energy and I'm a little bit more optimistic. I think there's some good things happening. SPR reserves, the basically the U.S. government was selling oil and driving its price down, and now they've got to refill the SPR. That should give a boost. And I just think we're in an environment where people are not going to give up some of the things that they enjoy right now, which is travel and some of those other things, very easily. I think if this is a recession we're going into, it's going to be a rolling recession. I think housing can continue to get hurt. I think things that are rate sensitive continue to really be troubled. But I don't think people are going to stop traveling and those sorts of things as much. I think that's people did not want to give up on those things following COVID. When everyone was shut in and not able to be out and living their life, I think people are going to continue to do that. So I'd be more optimistic that people are going to hop on flights. They're going to go out to eat. They're going to travel. They're going to do some of those things, even if we go through kind of a rolling recession. I'd be much more worried about like housing, for example, than I would about energy consumption from that side of it. So I think there are some demand drivers there that can continue. So that's a little bit of a difference of opinion, I suppose, that we have. But you look at the weekly performance for this past week, and it's definitely a risk on right now. So I touched on this the past couple of weeks, and I always say, the market will grade your work, and they'll give you a grade. Well, right now we get a passing grade. I've been calling for equities to go higher. My thesis again is that we pierce that downtrend line. This is where max pain is. We talked about it, that everyone's trading against this downtrend line. I think the market's poised to go up and through that, which will trigger stops. It will confound and confuse, and people will be saying, this is ridiculous. Why is this happening? And it's just the nature of markets. Pessimism got way too high. Put to call ratios skyrocketed. People are just so nervous. The average individual selling all their stocks and such, those tend to be poorly timed at least. So here is the review. There's your 5-wave pattern to the downside. Here's how I see it. We've had the A, this is the B, one more C, and then all hell may break loose. But we are currently in that minor advance, and it's relatively minor because we can see a more major decline coming later on. By the way, a move above that downtrend line and back above the 200-day moving average will cause most people to say, oh, we're out of the bear market. We're good. Stocks are about to go back up to new highs and so on. It will change the optimism pessimism dynamic. It will be one of those situations where I think it'll be a sucker's rally in the end, because we're likely to go back to those lows and even through those lows in 2023 later this year. So we're in this phase, we're in the ABC phase, and we're currently advancing. Now the CPI comes out this week, and that's going to have some volatility. So I would expect a 1 to 2% move minimum in stocks on, well, tomorrow morning, right out of the gates. So for this week, not too much happening. It's certainly somewhat following expectations. I'm more risk on versus risk off. So you're getting the risk off selling. You're not really getting the risk on buying. They're just more flat-ish, but if you paired those up, you could be in okay shape there. Not too much happening though thus far. That'll change. Again, tomorrow morning is going to have some fireworks, I'll bet. Crypto bouncing back. not a major surprise, but the bottom was ultimately on that FTX news. We talked about it at the time. Now, I'm not an ardent bull on crypto. Okay, I think most of it's junk. I'm not a big buyer of any of the crypto space, but if you were, like we talked about, if you are long-term bullish, you had to be a buyer when it collapsed on the Sam Bankman-Fried FTX news. That is just investing, long-term investing 101 is you buy and you put away what you want to buy when there's blood in the streets, when chaos ensues. Those are the times where the prices are discounted. So as you kind of look at it, it's really pretty interesting that that ended up being the low in crypto. It was the low point, and we've rebounded, not significantly, but we've certainly rebounded since that time. We're now above the 20 and above the 50 in the S&P. We're pushing higher in the short term, but is it off to the races? Well, probably not. Probably ultimately going to stall out, but enjoy it while it's happening. Uh, it's it's not going to last that much longer. As we look at international equities, they've had kind of a double benefit. Not just the advance and those things, but also the dollar weakness. These tend to move opposite to USD. I would expect international stocks should continue to outperform overall, so I'm not surprised that they're acting a little better than the S&P and U.S. markets right now. As we look at crypto, as we said, it was really on that Sam Bankman-Fried. That was the bottom. And look, from that news hitting, and we collapsed down here to 9,000, we're back up above 11,000 in a crypto basket. So again, it's not insignificant. You know, if you think about it on a percentage term, it's up over 20% in that period of time. Now it got there pretty quickly, and now it's gone sideways ever since. But ultimately, that was the bottom, at least a temporary bottom. Now, as in a crypto basket, I would ultimately expect that we're probably gonna go lower. Um, Bitcoin, Ethereum, the bigger players, I think will outperform the others, but I'm not super optimistic on the entire group. I'm not in a rush to buy by any means. Let's look at the rest of this week. This is the one you've got to have circled, and this is it this week. This is make or break for everything. And if you're trading any currency pairs, just be aware tomorrow is going to create volatility across the board. Really doesn't even matter if you're not trading US dollar. Your currency pairs are still going to move somewhat on this announcement. Now, if we look at the numbers, the expectation is for negative inflation, a drop by 0.1. This is the year-over-year number, which is expected to fall to 6.5. Now, where did they come up with that? Remember, it's a rolling forward, so you get 12 months worth of data, and that gives you your annual inflation. Here's the good news for the market, and part of why I felt like there were a lot of boxes that we could check that led me to believe that the market was going to rally here early in the year. You know, January effect, where the things they sold for tax purposes, they tend to rebuy the laggards in the new year. That was happening. Technically, ABC correction. Fundamentally, people got negative and pessimistic, and the earnings haven't deteriorated in most industries yet. It takes time for some of these things to come through. You look at the Fed, and it's kind of questionable and at least slowing its rate hikes. You look at inflation, and inflation would be another factor. So what's the good news here? Well, even if, let's just say this came in at zero, perfectly at zero versus a negative, it still takes your inflation year over year down because you're getting rid of last year's number. Last year in January, I think the inflation rate was plus 0.4. So if you get rid of that and you add this, you drop by 0.4% year over year. If you add a negative, Well, you drop by 0.5%, and so on. The point is that unless the CPI number came in at plus zero point 0.2 or something, it's going to have a pretty significant drop in the year over year number. And that's good, and it's not done yet. Now, our highest inflation numbers on the monthly were right in the summertime. I think July was the peak. I think in July of last year, we had plus 1.3% inflation, which was the peak. So it's going to take a few months for us to get rid of that one and put in a lower number that again will hit that year over year number and bring it down. But as you do that, we might still, I think what the real risk to the market is that we stay at a sticky higher number. There's no question that in the summertime of this year, we're going to be getting rid of some big inflation numbers and inputting likely some much lower numbers. So this inflation number should drop, but it might still be at 4-ish% year over year. And that's twice the Fed's mandate. So I think we've got the good news right now where the trend is falling in inflation. The bad news comes later when it stagnates and it's still at 4%, 4.2, something like that, which I do think is going to happen, which means the Fed has to keep raising rates and or keeping them higher for longer. There's probably a scenario where the Fed funds rate and the inflation rate have to cross each other. Now that's going to happen on both parts. The Fed probably has to keep rates up for a while, and inflation, it's going to take some time for it to come down, and then they'll intersect, and then the Fed will kind of breathe a little bit of a sigh of relief that at least that's happening. But this is still a bit of a problem for markets. And inflation, the genie's out of the bottle a little bit, and we're probably going to be dealing with the sticky high 4%. I think it's coming down. I've been long saying we're on this trend. If you just look at those numbers, they're going to keep falling, but then you start to project it out, and it's like, hey, we're still going to be in the fours. It's going to look a lot better than 9% year over year inflation, but it's still way too high. So that's a problem for another day. That's probably more of what's going to fuel this to the downside. Let's jump over and take a look at a few charts here together. And that's not the one that I want necessarily. Well, let me see here. Maybe it is on this. Oh, I've got it here. Okay, so let's take a look at this. Crypto. We had a request to chart crypto, and I don't know that there's a great charting aspect to this, but if I were charting it, just from the standpoint of, not my opinion, just what's happening in the chart in front of you, I would have to give credit where credit is due. You have essentially started to move up and attempting to move up and through this descending triangle. Are you confident that it's going to break out and is robust and so on? It really hasn't had the breakout of sorts. I mean, volume did spike as it crossed above that, but it's not really accelerating further. Usually we're not really inclined to buy breakouts when you have a lot of overhead supply, and this one certainly has overhead supply in spades there. So I'm not so sure that I, am really super excited to buy breakouts. I'd rather buy the dip. But give credit where credit is due. It is enough strength to at least cross that. Now the moving averages kind of tell the story. They're all bunched together. They're all going sideways. What does that mean? Well, it means that we're in more of a sideways pattern than any sort of trending momentum pattern. So just be aware that really hasn't changed. Let's go look at some currencies. So US dollar broke out of its little range here to the downside and then immediately bounced back. Not a deal breaker for shorting the dollar, but not ideal. Tomorrow's going to dictate whether this breaks and holds or it comes back up into the range. Either way, it's kind of a good trade in that if we move back up in on the CPI. Imagine we start to bounce back up here. Why is that a good thing? Well, from a false move comes fast moves oftentimes. So we've been kind of squishing. If you look at the US dollar index, the Dixie, it's been trading around that key 104 level, and we've kind of squished down below 104. This might be the springboard back kind of into the range and recovery. So I sort of like buying the USD on a move higher here, or obviously if we break down, well, then this breakdown is in play. I mean, you could kind of go either way, just trade with the momentum of tomorrow's CPI news. If we're breaking higher in the US dollar, I might pair it up against some of the European currencies or something like that. If we were breaking lower in the US dollar, I'd probably be buying CAD or Aussie or Kiwi, something like that against it. But dollar's kind of interesting from that standpoint in that it's at that sort of make or break level here. Japanese yen, we touched on this. We actually did have first the burst. I was surprised it pulled back as far as it did, and I was wrong in that it did have another spike. I thought it was going to have another spike after a very shallow. Usually these shouldn't pull back hard with that big of a break. It'll first give you a shallow and then spike one more time. And this next spike doesn't go as far as this one, but it's certainly profitable. It's certainly a good. This one kind of surprised me. It pulled back deeper and then it had the spike. But nevertheless, we're now in that corrective mode. We're now kind of pushing back in. This is a good thing in my mind. This gives you the opportunity to buy yen cheaper later on. And it really is moving kind of inverse to equities, which it should to a certain extent. I'd love to see another push to the downside and kind of an exhaustive type of move. Some candle that comes off the lows, hammers, something like that. And then we should be, in the coming months and weeks and so forth, advancing further. Right now, we've got a little bit more room to go down, perhaps. Now, if equities are going to make that break above the downtrend line, one would think that the Japanese yen should kind of break a little lower for now. Yeah, the Japanese bond market is tricky because it's not really free to trade on its own. They'll only allow it to deviate certain percentages and so on. That was one of the changes that the Bank of Japan made, where they had to relent and give in a little bit. But it's hard to trade those Japanese bonds because they're kind of a pegged yield, and that makes it tough. Swiss franc, we're still in this range here, top end of the range, bottom end of the range, and breaking down. This follows my outlook in that I'm more risk on in the short term. So Swiss franc should be going down like the Japanese yen should be going down, like the US dollar should be going down. Euro's still acting pretty well. That's been in play for some time. British pound is choppy. Look at all the moving averages bunched together. CAD is starting to finally go. We touched on this last week that I kind of changed my opinion as we were looking at the CAD live in class and saying, boy, it's not going down on some bad news, on some energy price spikes to the downside and so on. And sure enough, it staged a nice reversal back up, pulling back a little, and looks like it's poised to bounce. Aussie's been the strongest of the risk on, and then Kiwi's kind of lackluster here of late, just choppy. But I would still continue to look to buy things like CAD. I think that makes sense. Now, the euro was kind of interesting. I don't know how many of you spotted this, but if you come over to the euro charts on the daily time frame, so let's take a look at this together. You can see kind of, well, let's go euro USD. You can see here just a couple of days ago, we had something that I personally look for, a bullish Bollinger Band setup. and hopefully you spotted it. Euro USD is always kind of charting 101. It's a currency pair that you certainly keep a close eye on, and it just trades so well from this technical setup. I mean, look, here was a bearish Bollinger Band signal in April of 2022. You couldn't find a better bearish setup. This one sorta, kinda, certainly fell off. Here, definitely met criteria, hit the upper band below the 50. Fantastic. Here again, fantastic. Then the trend reversed, and this is our first buy. Now, will this buy be as good as these shorts? I mean, this is just, what a short. What a great short. What a great short. What a great short, right? Now we're in reverse, and so far so good. This is a good long, and it might become a great long setup. But you know, that's the essence. If you're not familiar with it, go watch our Bollinger Band video where we kind of talk about that concept. Now, a lot of people screw up that setup because they trade on the opposite side of the 50. We only short when we're below the 50. We only buy long on this setup when we're above the 50. But if you get that right and you got that Bollinger Band setup, it's kind of interesting. What do you think about gold was the question. I'm in a long position. So gold, let's go back to these charts. And you can see on a really longer term basis. I mean, let's go back to a weekly. Let's go back in time, something like this. And let's just really look at what's happening here. So it's not picture perfect. It's been very, very choppy in here, but it's pretty good price action overall. Here was the all-time high in gold in 2011. From there, we fell off, and we fell off dramatically. We used a lot of energy and a lot of buying just to get back to that. And as the markets often do, see how it squished into resistance and then sprung the other way? Squished into, this is where gold should have taken off. This is where, frankly, I expected it to. I lost a little bit of money on this one. You know, I traded some of this stuff so perfectly. I shorted gold in here so perfectly. I mean, it was fantastic. But this one, I admit it screwed me over, because this should have been the cup and handle. I mean, it was perfect. And by the way, I was buying gold down here in the handle, and it worked perfect. I mean, it was just so clean, so perfect, just trading just as it should have. But here's where it should have broken out, and it didn't. It was a failed move there. And the third time should have been the charm. That's the way the cup and handle works, and you should have taken off. And instead, it had another failed breakout, and we fell further. So is this all part of this bigger handle? Is it just, you had a cup that took years and years and years to build? Is this just part of a bigger handle that's going to take a year or two to build, a couple of years or something? If that's the case, you're still going to have some downturns in gold. It's probably not just going in a straight line here, right? You're going to fall off, and then you'll go back up, and you'll fall off, and then you'll eventually break out. I think that is what's going to happen. I think that's how it plays out, but that does make me nervous about gold in the short term. It's been on such a run. Remember, we're on a weekly chart. If you were to count, it's basically been straight up in the air for about 10 weeks in a row. It's due for a correction, the type of move that fakes people out and so on. And it's not that it falls apart. It should just pull back and then kind of find that rounded area and then start to bounce back and so on and work its way up there, right? So that's where I'm at with gold. Optimist on it, but in the short term, I think I would be taking some profits off into this advance. And oh, by the way, if you zoom in here and you kind of look at it and you think, man, we've gone up. I mean, here's the breakout. You might see an exhaustive type of, like maybe there's a big burst this week on the CPI or something, or maybe it just falls apart. I don't know, but it's probably the week. We might get a really, really perfect signal to sell tomorrow. Imagine this thing like spikes up on the CPI or something like that. I would cash in because you're very likely, this is how mean reversion works. We're on a long-term chart, but still same concept. These moving averages need some time to catch up and so on. And that means we should back and fill for a few weeks. So that is exactly, if I'm painting the picture, this to me is what comes next. Now, I could be wrong about that. It doesn't have to occur, but I would certainly be tempted to look to cash in and rebuy at substantially, better prices. So if you have a really long-term horizon and you're not trying to play the little moves, like you're not worried about it falling off 5% or something, well, by all means, stay long. Because I do think ultimately it's up and away is the big picture. So I hope that's helpful. So coming back to kind of tie a ribbon on things, for the rest of this week, we've got our recap meeting going out tomorrow. We've got the trading room coming out this weekend, and then as always, we'll have a full slate of classes on the calendar next week. But be aware of the CPI that comes out tomorrow morning. Expect the futures, expect the currency markets, expect everything to take their cue from that CPI and move. And the odds favor a low CPI print, which should be risk on. It should be good for equities, but you can never be too sure going into something like that. So be aware of that. There will be some volatility tomorrow morning at about 8:30 a.m. Eastern Time. Have a great rest of your day, and we'll see you next time. Goodbye, everyone.